Hey everybody. So we're going to talk about adjusting entries or adjustments, and they can be a little confusing at first. In fact, they can be a little confusing at second. In other words, sometimes it takes people a little while to get used to them. And so I'm going to do my best to sort of walk through them here. And there's a lot of examples, so this is going to be kind of a long presentation. So just prepare yourself ahead of time. But it's really important, and it's kind of a foundational concept that will come up over and over again in accounting. So it's worth the effort, I guess, to try to learn it and understand it. So I guess I should start with the type of accounting that we're doing and that most of the world does is called accrual-based accounting. And in accrual-based accounting, we recognize that the cash doesn't always match up with the revenue and expenses. And what I mean by that is sometimes we get paid cash right when we earn the revenue. So we do some work for somebody and then they pay us. But other times it doesn't match up, meaning we do the work for them, but then they pay us next month. Or maybe sometimes someone pays you in advance for work you're going to do later. The same thing happens with expenses. Sometimes we pay cash right when we incur the expense. We go to the store, we get something, and we pay cash for it. But other times we incur expenses. Maybe we use our electric power, but we're not going to pay for that expense until the next month when the bill comes out. Or other times we get billed in advance. So we actually pay money, but we're not actually going to incur the expense by getting the benefits of the services or the products we're getting until a future date. And so because of this, we have to do what are called adjusting entries to recognize on our financial statements at the end of a period, okay, a financial period, which is a period of time, those expenses that we've incurred, even if we haven't paid for them, and those revenues we've earned, even if we haven't received the money, and those expenses that we have, and that money we've received, but we haven't yet earned, or those expenses that we've paid for in advance, but that we won't actually incur until a future date. We've got to recognize those appropriately on our financial statements, and this can be a little confusing. So what I have up on the screen right now is, it's in a framework for adjustments. So there's 4 types of adjusting entries that we deal with in accounting. And you can see them there on the screen. So there's 2 that are called deferrals. And you know the term defer means to put something off until a future period. And then there's 2 that are accruals. And to accrue something means to add it up or build it up over time. So the first type of deferral is called a deferred expense. This is when an expense is paid in the current period, but we're not going to incur that expense until a later period. And I'm going to go through some examples of each of these, but I'll give you a brief example. This could be something like our insurance, that we pay for a whole year's worth of insurance all at once, but we can't really say we've derived the benefit from it, which is what it means to incur an expense, until some future period. Maybe each month we derive some benefit from that year's long insurance policy. And so if the problem is, if we record it all as an expense the day we pay for the insurance, we have this big expense up front, but nothing to really show for it. And then over the next 12 months, we have no expense, but we've been getting the benefit of it. So instead, what we'll do is we'll do an adjusting entry to recognize the incurring of that, or that we've paid that expense in advance, and then we'll recognize the expense as we incur it going forward. So that's a deferral of expense. The second is a deferral of revenue. This is where revenue is received. Someone pays us, but we haven't earned it yet, and we're not going to earn it until some future period. So again, this happens all the time in business. I own a storage business, so oftentimes people will pay me for a whole year's worth of storage. What I have to do is I have to show my cash going up because they paid me, but I haven't really earned the revenue. And if I were to record it all as revenue when they pay me, I would show this big chunk of revenue in 1 month, but then no revenue for the next 11 months. Instead, what I want to do is recognize that cash going up and record the liability unearned revenue. And then each month, as I've earned it, I'll do an adjusting entry to recognize the earning of that revenue. So those are the deferrals. The accrued expense, this is where expenses incurred in the current period, but we're not going to pay it until later. That's pretty normal for things like our salaries and wages, right? We pay our employees every 2 weeks or something like that. And so as they work, we're incurring an expense, right? We owe them for what they've done. But when we get to the end of the financial period, we haven't even recorded it because we usually only record it on payday when we actually pay them. So we have to do an adjusting entry to recognize that expense we've incurred for the employee's work up to the end of the financial period. So that expense will show up on our financial statements. And then in the next financial period, we'll actually pay them on payday. And then accrued revenue is revenue that we've earned in the current period, but we won't receive it until a later period. This happens a lot for firms that do service work. They'll do work for people, and then at the end of the month, they'll sort of add up the amount of work they did, the hours or whatever they did for the person, and bill them for it. So at the end of the month, we have to record that we've earned that revenue, so it will show up on our income statement, but we won't get paid for it until a future period. So those are the 4 types of adjusting entries. And now I'm going to walk you through a number of examples. And this is the part that's going to get kind of long. So I apologize in advance, but I think it will be valuable to look at these examples. So one type of deferred expense is called a prepaid expense. And this was the example I used just a minute ago, was like prepaid insurance. We pay for our insurance for a whole year. Sometimes we pay for rent for a whole year in advance, or 3 months or 6 months in advance. And so what we have to do is we have to recognize that prepaid expense as an asset. So when I pay for, let's just use insurance as an example, in advance, we're going to create an asset called prepaid insurance. Then, as I use up that asset by having insurance coverage, we're going to record it as an expense going forward. So here's our process. So on, let's see, December 1st, 2019, we pay $2,400 for insurance coverage for 24 months. So what we're going to do at that point is record $2,400 to an asset called prepaid insurance. Also with that same entry, it doesn't show it on here, but we would show our cash going down, right? If we paid $2,400, we'd be, in essence, debiting prepaid insurance and crediting cash. That would be our initial entry. Then at the end of each month, if it's a $2,400, or a 24-month policy, we would figure out, well, how much expense do we actually incur each month? And if it's $2,400 for 24 months, that means we would be incurring $100 a month in insurance expense. So each month, we would record what's called an adjusting entry, always recorded on the last day of the month, for that amount of expense that we're actually incurring for the month. So at the end of that first month, we would debit our insurance expense and credit prepaid insurance. At the end of that first month, our prepaid insurance would now have a debit balance of $2,300. What this allows us to do is recognize the expense of the insurance we actually used for the month, but still carry the asset for the amount of insurance the prepaid insurance we have going forward. So we'll keep doing this every month. At the end of each month, we'll do a $100 adjustment, and we'll expense it, or in other words, we'll record it as an expense until the end of 24 months, when our prepaid insurance will now have a balance of 0, and we'll have recognized insurance expense of $100 a month over the 24 months. All right. Similarly, when we purchase supplies, and supplies are typically assets that we're going to use up or consume over time, okay? What we do is record an asset called supplies. Makes sense. Then what we do is at the end of each month, we count up how much supplies are still there. In other words, it doesn't make sense for us to keep track of how many sticky notes or pens we use as we use them. That would just be tedious. Instead, what we can do is at the end of the month, we can count up how much we have. And then from that, we can calculate how much we used. So if I had $9,720 of supplies, and at the end of the month, I had 8,670, I'll know that I used $1,050 worth of supplies during the month. I just subtract, right? What I had minus what I have at the end is how much I used. And so then I can do an adjusting entry to recognize the supplies expense. And so in this case, it's $1,050 debit to supplies and $1,050 credit. I'm sorry, $1,050 credit debit to supplies expense and $1,050 credit supplies. So there's my adjusting entry. And again, I'll keep doing these adjustments until I add more supplies. And then, well, at the end of every month, I have to record how much supplies I've used up. So that's the adjusting entry for supplies. All right, so depreciation is the third type of deferred expense. And it's kind of one of the more confusing ones until you get used to it. So we recognize when we buy a big asset like equipments or buildings or automobiles, that we're not really, again, we can't just claim them all as an expense right in the month when we buy them, especially a building that costs $300,000. If we had a big expense for 300,000 and then no expense over the rest of the building's useful life, it would be not recognizing how the building actually benefits our business. So instead, what we want to do is spread out the cost of the building and recognize it as an expense spread out over the asset's useful life. Okay. And so we'll use for this class a formula called straight line depreciation. Later, we might learn other types of depreciation, but right now, just straight line. And to figure out the amount of depreciation, we take the cost of an asset minus its salvage value. And salvage value is what we believe when we purchase the asset, its value will be at the end of its useful life. And then we divide it by its useful life. So the useful life is just how long we expect the asset to work to keep working. Okay. By working, I mean helping us generate revenues. All right. So here's our example. We purchased equipment on December 1st for $26,000. It has an estimated useful life of $5,000, and it has a salvage value of $8,000. So what we're going to do is we are going to recognize that its useful life is 5 years or 60 months. So to figure out the amount of depreciation we're going to recognize each month, we'll take the original value minus the salvage value, and that will give us the net cost. Sometimes they call it the depreciable cost, or the amount of the cost we're going to depreciate. Okay. So once we have the net cost, we'll divide that by the number of months in the asset's useful life. So in this case, the 18,000 divided by 60 gives us $300 per month. What that means is instead of taking the expense for the equipment of, say, the whole $26,000 when we buy it, or even the whole 18,000, the net cost when we buy it, instead, we're going to recognize the expense of this equipment as $300 a month for the next 60 months or the next 5 years. We're spreading the cost of the asset out over its useful life. So we're going to make an adjusting entry then each month at the end of the month, which will be a debit to depreciation expense and a credit to a special account called accumulated depreciation. So on the other two deferred expense examples we used, we just made the adjustment right to the asset account. But with long-term assets like buildings and equipment, we're going to depreciate those using a special account called accumulated depreciation. This allows us to keep our equipment account at the cost. And so there's a special number we'll see where we have our cost minus accumulated depreciation gives us what's called the book value of an asset. And so we'll use that later. Just recognize that we're gonna, when we do the depreciation expense adjusting entry, we're always gonna debit depreciation expense, credit the accumulated depreciation account. So that's what it will look like on our balance sheet. It always gets listed where it shows the asset, and then it'll say less accumulated depreciation. And then the difference between those two will be shown as the book value of the asset. So in this case, $26,000 was the cost of the equipment, less $900 in accumulated depreciation, gives us $25,100. And that 900 comes from, if you look at the date on that balance sheet, it's at the end of February. So at that point, they've recognized 3 months worth of depreciation at $300 a month. Okay, so those are our deferred expenses. Let's take a look. And by far, that's the most complicated one, I think. So hopefully the other ones will go a little faster here. So let's take a look at deferred revenues. Remember, like I said, a deferred revenue is where we have been paid money in advance, but we haven't actually earned the revenue. So we're going to defer or put off the recording of the revenue until a future period when we've actually earned it. So here we have a company's, so our company's client pays us 60 days worth of fees in advance. So when that happens, we're going to record a debit to cash, an increase to our cash account, and then we're going to credit a liability account called unearned consulting revenue, or sometimes it's just called unearned revenue. It's a little confusing, right? Because it has revenue in the name, so you would think it's a revenue account, but it's not. It's a liability called unearned revenue. It just means money we received but haven't earned yet. So now, when we get to the end of the month, we have to figure out, well, how much of that money have we actually earned? Okay, so they're paying us here for 60 days worth, and they're paying us starting 12/27. So as of 12/31, the end of the month, we'll have earned 5 days worth of that revenue. So if we take 5 divided by 60, since this money, the 30,000 represents 60 days worth of work, and then multiply that by the 3,000, that will tell us how much of the revenue we've earned as of the end of the month. So in this case, we've earned $250 in the revenue at the end of the month. So we'll do an adjusting entry where we will debit the unearned revenue. In other words, we're reducing the liability because once we've earned it, we no longer owe it. And then we'll credit consulting revenue to show the increase to our revenue. You can see at the end of the month, we still owe this client $2,750 worth of work. There's what our adjusting entry looks like. All right, so now let's look at accrued expenses. Remember, with accrued expenses, what's happening is we are incurring the expense, but we're actually not going to get paid for it until later. So here's an example. We pay our employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. So on December 31st, the end of the month, is a Wednesday. So there's 3 days salaries owed, right? So we would have paid them on the last, the Friday before this. So we've, at this point, only accrued 3 days worth of salaries, Monday, Tuesday, and Wednesday. And again, remember the purpose of these adjusting entries is so at the end of the month, at the end of the financial accounting period, we can record our expenses and revenues correctly for the month. So in this case, at the end of the month, we owe $210 in salaries. that we've already incurred the expense for. So we want that to show as an expense on our income statement and as a liability, the money we owe our employees on our balance sheet. So what we'll do is we will debit salaries expense because we've incurred the expense, and then we'll credit salaries payable, a liability, because we wouldn't credit cash because we haven't paid cash yet. You probably noticed a pattern by now that in all these adjusting entries, there's never been cash, okay? That's because there will never be cash in an adjusting entry because these are an attempt for us to record revenue or expenses when the cash is coming beforehand or it's coming later, okay? And so we won't see cash in the adjusting entries. All right. So we'll see our salaries payable now has a credit balance of 210, and our salaries expense is the salaries we've paid previously plus the amount of the adjustment. At some point in the future, though, on payday, when we actually pay our employees, we're going to have to get rid of that liability because we will no longer owe the customer. So at that point, what we'll do is we'll debit salaries payable for the amount of that liability we had, and then we'll debit salaries expense for the amount of salaries the employees have earned since January 1st, since the beginning of the financial period. And then we'll show the cash being paid out for both of them. So we debit salaries payable, debit salaries expense, and then we'll credit cash to show that we've paid both what we owed from the previous financial period in December, plus what we owe them for the 7 days that have happened so far this month. All right, one more, and this will be our accrued revenues. So again, these are revenues that we've earned, but we're not going to get paid for until some future period. So here's an example. Our customers agree to pay $2,700 on January 10th of next year for future services over the next 30 days. So if we made this agreement on December 12th, that means as of December 31st, the end of the month, we've actually earned 20 days worth of those services, but we're not going to get paid for them until January 10th. So what we'll do is we'll take 2,700, which was the total amount that we agreed to, multiply that by 20 over 30 to represent the 20 days out of the 30 that the whole 2,700 was for. And that tells us that it's $1,800 that we've earned so far this month. And again, we've earned it. So we want that to show up in our revenue on our income statement for this current month, December. And we also want to show the asset accounts receivable because that belongs to us. We've earned it this month. You'll see we debit our accounts receivable, and then we credit our consulting revenue, and that just gets added to consulting revenue we'd already earned previously in the month. Then later, when we actually get paid the full 2,700 on January 10th, we would debit cash to show our cash going up. And then we would credit accounts receivable because now the people no longer owe us. They've paid us for the 20 days from December, and then for the additional 10 days during January, the 900. All right, so there are the 4 types of adjusting entries. I've tried to explain a little bit about why we do them and kind of how we do them. And I hope that was useful to you as you jump into this. Again, it can be confusing, but it's important. It will come up again and again. So it's important to sort of work to try to really understand what's happening with these. Good luck on the assignments this week. And as always, if you have questions, don't hesitate to email me or let me know.